What if I told you that your salary is not small by accident? That it is not random, not temporary, not a phase you simply need to push through? What if I told you your income is operating exactly where the system prefers it to be? Not because you're lazy, not because you're unlucky, not because you haven't worked hard enough, but because the structure you work inside was never designed for most people to break far beyond a controlled range. That sounds extreme, but stay with me. If salaries grew freely and exponentially for the majority of workers, corporate profit margins would compress. Asset prices would destabilize. Entire valuation models would shift. So the real question is not, why am I not earning more? The real question is, who benefits from my income staying predictable, controlled, and limited? If you don't understand that, you will spend your life negotiating inside a system that was never built for you to win big. And that matters today more than ever. Because inflation is rising, housing is expensive, healthcare costs are climbing, education is costly, yet most salaries grow slowly, if at all. You may get a 3% raise. But rent rises 8%. Food rises 10%. Asset prices double. And suddenly you realize something uncomfortable. You were running, but the finish line keeps moving. So let's break this down clearly. Not emotionally, not politically, structurally. There are patterns here, and once you see them, you cannot unsee them. The first core idea is this: salaries are an expense. To you, your salary is survival. To your employer, it is cost. Every company exists to maximize profit. That's not evil, that's structural. Public companies are legally obligated to prioritize shareholder returns. If revenue increases, there are only a few places the money can go. Reinvest into growth, distribute to shareholders, increase executive compensation, or raise employee wages. Guess which one is the easiest to control? Wages. Because employees are usually fragmented. Shareholders are organized. Executives make decisions. Workers negotiate individually. That imbalance matters. Companies invest millions in cost optimization systems. They analyze productivity, automation, outsourcing. They measure how to get more output per dollar of labor. From a business perspective, the ideal scenario is simple: maximum productivity, minimum labor cost. This doesn't mean they want you poor. It means they want you efficient. And efficiency in corporate language often means replaceable. Now let's go deeper. The second core idea is supply and demand of labor. If there are 500 qualified applicants for one job, who has the power? The employer. Globalization and technology expanded the labor pool massively. Remote work means your competition may not just be your city. It might be another country. Automation replaces repetitive roles. AI replaces cognitive tasks. Software replaces coordination work. When supply of labor increases faster than demand, wages stagnate. This is not personal, it's economic gravity. You might be excellent at your job. But if thousands can do something similar, your bargaining power is limited. And here's where psychology enters. Most people focus on working harder. But hard work increases output, not necessarily leverage. Leverage is what changes income. The third core idea is performance illusion. Many employees believe that if they perform exceptionally, their salary will naturally rise significantly. Sometimes it does, but often, performance increases expectations, not compensation. Why? Because companies benchmark salaries against market averages, not individual effort. If the market rate for your role is $60,000 and you perform like someone worth $90,000, the company may still anchor you to $60,000, $70,000. This is anchoring bias in action. The initial salary range becomes the reference point. Your value is framed inside that range. Breaking outside it requires structural change, not just effort. And most employees never renegotiate structure. They negotiate percentages. 3% raise, 5% bonus, small adjustments inside a fixed ceiling. Now the fourth core idea: dependence. Salaries are predictable. That predictability creates psychological comfort. You know when money arrives. You build your life around it. Rent, bills, loans, all synchronized. But predictability reduces risk-taking. When you depend entirely on one income source, your negotiating power drops. Because walking away feels dangerous. This is called loss aversion. People fear losing stable income more than they value potential upside. So they tolerate stagnation. Over time, this creates a silent trap. You stay in roles longer. You avoid conflict. You delay career pivots, not because you lack ambition, but because stability feels safer than uncertainty. And companies understand this. Now let's intensify the analysis. The fifth core idea is inflation versus wage growth. Look at the last few decades. Asset prices, real estate, stocks, commodities have grown faster than wages. Why? Because capital compounds. Labor does not. If you earn $70,000 per year, your income grows linearly. If you own appreciating assets, your wealth grows exponentially. The modern economy rewards ownership more than effort. Investors benefit from rising stock markets. Property owners benefit from rising rents. Business owners benefit from scaling revenue without proportional salary increases. Employees trade time for money. Owners trade systems for money. That difference compounds over decades. This is not about fairness. It's about structure. And most people are positioned on the labor side, not the ownership side. Now let's challenge a common belief. People say, get more education and your salary will rise. Education can increase income, but when degrees become common, their signaling power decreases. If everyone has a degree, it becomes the baseline. Then you need experience, then certifications, then specialized skills. The bar keeps rising, but the salary ceiling often moves slowly. You invest time and money into education. Companies receive more skilled labor without proportionally raising pay because supply increased. This is credential inflation, and it quietly compresses wages. Now let's look at power. Large corporations influence policy. They lobby for tax structures, labor flexibility, and regulations that protect margins. Again, not necessarily malicious, but rational from their perspective. If labor laws are strict and unions are strong, wages rise. If labor markets are flexible and unions weaken, wage growth slows. Power shapes income distribution. This is why productivity has increased dramatically over decades, but median wages have not risen at the same pace. The gap between productivity and wage growth tells a story. The gains did not disappear. They shifted toward capital, toward ownership, toward shareholders. Now here's the deeper psychological layer. Most people are conditioned to equate salary with success. What do you earn becomes a status metric. So people focus on increasing salary rather than increasing leverage. They chase promotions within structures designed to cap growth. They compare themselves to peers in the same system. That comparison keeps the ambition contained. It feels competitive, but it's competition inside a narrow lane. Meanwhile, those who build equity, businesses, intellectual property, or scalable systems operate in a different game entirely. And here's where it becomes uncomfortable. The system doesn't need most people to become financially independent. It needs most people to remain stable consumers, predictable earners, predictable spenders, predictable borrowers. Consumer spending drives economic growth. Stable salaries support borrowing. Borrowing supports asset markets. Asset markets support capital holders. If everyone aggressively pursued ownership and independence at the same time, consumption patterns would shift. Debt levels would drop. Profit margins would compress. So the system nudges behavior subtly. Advertising encourages lifestyle inflation. Social media normalizes spending. Credit is easily available. You get a raise. Your expenses rise. Your savings barely move. You feel progress. But structurally, you remain in place. This is called the hedonic treadmill. As income rises, expectations rise too. Satisfaction resets. So even when salary increases, financial freedom doesn't necessarily follow. Now consider technology again. AI and automation are not just replacing factory jobs. They are entering white-collar roles. Data analysis, content creation, customer service, legal research. As productivity increases through technology, companies can generate more output with fewer employees. That reduces upward pressure on wages. If a tool can double productivity, companies don't automatically double pay. They maintain output with fewer workers. This increases profit margins. It doesn't necessarily increase salary pools. And here's a hidden pattern. During economic downturns, companies freeze hiring and reduce staff. During booms, they expand cautiously. The asymmetry means wages are sticky downward during recessions and slow upward during expansions. This keeps salary growth moderate across cycles. Now step back. Is your salary small because someone hates you? No, it is small because you are part of a structure optimized for efficiency, predictability, and margin protection. That structure values stability. Stability means controlled labor costs. Controlled labor costs mean moderate salary growth. Once you see that, the frustration becomes clarity. The goal is not to complain. It's to understand leverage. Income grows dramatically when you increase scarcity, ownership, or scale. Scarcity means you have skills few others possess. Ownership means you hold equity in assets or systems. Scale means your effort can reach thousands or millions without proportional time increase. Salaries rarely offer scale, they offer exchange. Time for money. And time is finite. The most important realization is this. Your salary is designed to stay within a band that keeps you productive, stable, and dependent enough to remain in the system. Not miserable, not wealthy, functional. Once you understand that, you stop asking, why won't they pay me more? And you start asking, how do I move beyond being only labor? Because the system is not broken. It's working exactly as designed. The real question is whether you will continue operating inside its limits, or whether you will build something that operates beyond them.